Okay, guys, we're now going to look at exercise 12.2. And here again, we're dealing with some held to maturity securities and then some investments in U.S. Treasury bills. Fairly straightforward exercise. We have FF&T Corporation is a confectionery wholesaler that frequently buys and sells securities to meet various investment objectives. The following selected transactions relate to FF&T's investment activities during the last 2 months, November and December, of course, of 2016. In November 1st, FF&T held $48 million of 20-year 10% bonds of Convenience Incorporated, purchased May 1st, 2016 at face value. Management has the positive intent and ability to hold the bonds until maturity. FF&T's fiscal year ends on December 31st. Okay, and then they give us some transactions that occurred during November and December and ask us to prepare the appropriate journal entries for each transaction or event. I'm going to start back with, I'm going to put in the years 2016. Guys, they don't ask for this entry, but let's make the May 1st entry when they purchased let's see, the Convenience Incorporated bonds. It says they were purchased at face value, so we debit on May 1. Investment in Convenience Incorporated bonds, and they were purchased at their face amount, $48 million. Okay, and FF&T would have paid cash for that investment, purchased at the face amount, so there's no discount or premium to deal with. And credit cash for the same amount, $48 million. Okay, then we get to and I just added that one in. We would not, they didn't ask us to do the entry for May 1st. The first one they asked for was November 1st, but thought we'd take care of that one as well. Okay, so on November 1st, it says received semi-annual interest of $2.4 million from the Convenience Incorporated bonds. Well, that means we have more cash. The asset increased $2,400,000. And the account we're going to credit is investment revenue for that same amount, $2,400,000. These entries are a little easier to make when there's no discount or premium to deal with in the purchase of the bond. Excuse me. Okay, then we'll go to December 1st. What happened there? Purchased 12% bonds of Facsimile Enterprises at their $30 million face value to be held until they mature in 2026. Semi-annual interest is payable May 31st and November 30th. Okay, so we just missed the interest payment date. Again, they have the intent and ability to hold these bonds to maturity. So we're going to debit investment in Facsimile Enterprises bonds. And the face amount there was $30 million. And we're going to credit cash. Got an asset to increase and an asset to decrease here. Okay, then on December 31st, purchased U.S. Treasury bills that mature in 2 months for $8.9 million. Debit investment in U.S. Treasury bills, and the amount of the investment there was $8.9 million, or $8,900,000. And the account to credit is cash. Okay, then on the 31st, recorded any necessary adjusting entries relating to the investments. Okay, we will have earned some interest on some of these investments by December 31st year end, and we need to make the adjusting entry to record that. So this entry is dated the 31st. So what's happened here, we have earned some interest on the convenience bonds and on the facsimile bonds that we haven't received yet. So we wanted to make an adjusting entry to record that. We'll call that investment revenue receivable dash convenience incorporated bonds. I'm going to finish that out on the next row. Convenience incorporated bonds. Okay, now how much interest have we earned? Well, let's see. We received a semi-annual interest on November 1st. So we've had 2 months of interest to build up since then. Okay, the bonds were $48 million bonds. So it's going to be equal to $48 million times the rate on the bonds was 10%. And then we're also going to multiply by what the months of the interest has been earned for the month of November and December, so times 2 over 12, and that gets us $800,000 in interest that we've earned in November and December on these convenience incorporated bonds that we won't receive until the interest payment date in the new year, which is let's see, if they're paid on November 1st, then they'd also be paid on May 1st, right? Okay. Do the same thing here. I'm just going to copy this one. It's a new account. I didn't spell that right. I tried to misspell it earlier. Facsimile Enterprises. Investment revenue receivable facsimile enterprise. Bonds. So same account. This one's just for convenience incorporated bonds. This one's for facsimile enterprises bonds. These are both current assets, ones that we're going to receive payment on, receivables that we'll receive payment on within the next year, less than 6 months actually. So let's see, how much interest are we due, or how much interest have we earned from the time we purchased the facsimile enterprises bonds on December 1st to December 31st. Well, it would only be 1 month's worth. The face amount of the bonds was $30 million times the interest rate was 12% for a year times, this is only though for 1 month, 1 over 12, so we get 300,000 interest were due there, or interest that's been earned in the month of December. And then our credit is going to be to investment revenue. The revenue was earned in 2016, so we want it recorded here. Equals our 800,000 plus the 300,000, or 1.1 million. You guys, we're not going to mark these investments in bonds where we have the intent and ability to hold them to maturity. Those are classified, remember, as held to maturity securities, and they're reported at their amortized cost. Okay, so let's go back. This takes care of your journal entries for exercise 12-2. If you have any questions, please be in touch with me. Thanks a lot.